Backspread option strategies. The backspread option strategy covers a number of setups, all of them designed to profit from volatile market conditions. Backspreads are a great alternative to non-directional option strategies such as the straddle and the strangle because they are cheaper to create. Unlike the straddle and strangle, which can realise potentially unlimited profits in both directions, a backspread's profit potential is unlimited on one side only and limited on the other side. Here are some other characteristics of the backspread. Firstly, a backspread will cost less than a straddle and can often be done for a credit. 2. A backspread will normally decay more slowly than a straddle. 3. A backspread needs less price movement than a straddle to move into profitable territory. 4. A backspread is generally less sensitive to changes in implied volatility than a straddle. 5. A backspread wins a smaller percentage of its cost than a straddle if you get it right. 6. A backspread involves either all puts or all calls, unlike the straddle, which involves both. Profits for put backspreads are unlimited to the downside and limited to the upside, while profits for call backspreads are unlimited to the upside and limited to the downside. The payoff diagram for a put backspread looks something like this. The red area signifies potential losses. The green area, profits on either side. Notice how the left green line shows unlimited profit, while the right green line points to limited profit to the upside. The payoff diagram for a call backspread looks something like this. You'll notice how it's the opposite to the put backspread payoff diagram. The V shape in both diagrams, which depicts the area of loss at option expiration date if the price of the underlying doesn't move much, is the part that is similar to the payoff diagram of a straddle. A backspread is similar to a credit spread in that, in both cases, you sell options whose strike price is closer to the current market price of the underlying and buy options whose strike price is further out of the money. The difference, however, is that with backspreads, you sell less positions than you buy. You do this because the options that are closer to the money will be more expensive than those further away from it. So you don't need to sell as many as you buy in order to still realise a net credit or a zero cost on entry. Because of this unequal number of bought and sold positions, it is often called a ratio backspread or reverse ratio spread. The backspread option strategy works best where the implied volatility in the short, that is the sold positions, is greater than the implied volatility for the long, that is the bought positions. Any good options broker should be able to give you this information. Backspreads are the opposite of front spreads. For definition purposes, the simple rule to remember is that when you buy more options in a spread than you sell, it is called a backspread. When you sell more options than you buy, it is called a front spread. When you buy and sell the same number of contracts, it is just simply a spread. Front spreads can be used very effectively to accelerate profits on bought shares with no extra cost. For information on how to do this, click the link at the top of this video. Taking advantage of volatility. The best time to get into a backspread is when you expect the price action in the underlying asset to become volatile in the near future. Fortunately, this is often highly predictable. The ideal circumstances under which to create a backspread is when the implied volatility in the out-of-the-money long, that is, in our case, the bought $55 positions, is less than the implied volatility in the closer to the money short, that is, the sold to open $50 positions. As the options delta in the bought $55 options increases when the price of the underlying stock in our example moves upward and through the $55 level, your positions will quickly enter into profit territory. In most cases, the profit potential is unlimited because you have more long positions than short ones. There are many factors which can trigger volatility in price action. These include upcoming earnings reports, news releases, court rulings, executive management changes, and other business or economic events that can affect the price of a stock. Some of these are predictable, others aren't. Applying a backspread strategy shortly before such an event that may trigger price volatility can produce wonderful profits. Now let's talk about risks in the backspread option strategy. Should the price action of the underlying asset remain stagnant for a period of time, the value of your backspread will slowly deteriorate. It is rare for stocks and commodity futures prices to remain stagnant for extended periods, but it does happen. If you're using this strategy, you should first be aware of the maximum loss versus potential rewards. Fortunately, maximum potential losses can be precisely calculated for any backspread option strategy that you choose. Pharmaceutical companies are often a good choice for the backspread strategy, particularly if a ruling is about to be made about the approval or otherwise of a new drug, because this can cause the price of the stock to surge one way or the other. With limited profit or potentially no risk to one side, and unlimited profit potential to the other side of a price move, when the backspread option strategy is applied under the right circumstances, it can be your best friend.